All right. Good morning, everybody. We're back to do it again. Going to take a look at a couple of things. We're still missing data. Of course, the government is still shut down. We're not going to get the job numbers that we normally would get. Right around the world, with small caps down the most, nearly 0.5%. It's kind of our line in the sand. So you can see all these things that we're not getting, the little asterisks next to it. We got Fed speakers chipping their teeth, and we will get you, Mitch. I believe the president's got something going on today, and that, of course, can cause some shenanigans. Yeah, right here, Trump greets the Hungarian prime minister. We could get something out of that. It's 11:30. Don't let the time on the screen fool you. And then we're going to get some kind of hit and miss data from European Central Bank and Bank of England, between those two chipping their teeth. So something that we've been keeping our eye on is the CTA positioning, and it's been in this tight little range here. We are moving back towards the bottom of the range. Now, this is just how much of their position do they have, right? It's their allocation. When they are exiting out of their allocation, the green line goes down. When they're holding, then we get this sideways chop, and when they're adding, it goes up. Kind of self-explanatory, right? Real simple concept. So they de-risked back here, and then they've just been holding with this allocation level, and we're getting a little bit of reduction, but we're not through the bottom of the zone yet. Now, it would be nice if we could see into this, right, with a little more granularity. And that's what Gamma Lab offers. So this is also CTA positioning. I chose net rather than, we got choices. I could have done percent of open interest or leveraged money percent of open interest. But I went with asset managers net positioning. It's a more zoomed in view, right? But we can see down below the starting at 2018, 2019, 2020, right? It's 23, 24. Now we're into 2025, and it's still this same positioning here, right? So they're not out of their positions in some grand fashion. Everything's fine. It's all just a matter of perspective. They are reducing their size a little bit. You could look at CTA reports or COT reports. Those come out, every Friday. We'll get new reports today. Morningstar is a website that you can get that data for free, and I think they do a relatively decent job with their charts. Barcharts.com is another one that offers COT charts, and I think Finance Juice, Stock Charts and TradingView have recently started to bring in COT charts. So, look around, see if you can get your hands on them, because some of these sites, they're pretty expensive, right? If you're not yet consistently profitable, you may find it hard to go and allocate funds into a bunch of different apps and tools and services to be able to get this. So If you look around, I think you can find things like Morningstar where you can get the COT report for free. That one that we get on Fridays, right? Then sure, it's a week by week snapshot, but it takes these guys weeks and weeks and weeks to move their position. They don't get it all done in a single shot. Keep your eye on crude throughout that Hungarian press conference. And then of course anything that that president can go on a tangent and just start talking about anything. So, FX volatility, start moving that dollar around, and then anything with US dollar Japan moving in the wrong direction could certainly whack us. And yep, the VIX is still above 20. So if we stay above here all day, we don't get back down below, it's hard to see any sort of rally with us staying above that $20 level, right? Now, it's not to say that it can't happen. We could get some violence and the VIX drop really hard, really fast. So I'm not saying that we can't rally today, but if we were to rally, I would expect the VIX to drop back down through that 20 line. So that could be one of the tells, right? Is that the VIX is turning tail and headed back the other direction. Real quick on the VIX, this is something that's often overlooked, but if you're trading VIX options, you really need to know what you're doing or you're just giving your money away, right? These options, we're just going to go out to January here real quick. These options that are at the money, they're not at the money. That's not where the money is. These options are based on the VIX futures. So if I'm looking at January 21st of next year, I need to know where the VX futures January contract is priced. And if it's priced around $22, then $22 is really at the money, not whatever I see here, right? I know it's a little more complicated than you're ready for on a Friday morning, but January 21.62. So wasn't quite $22. I guess I should have used February for my example. February is priced at $22. So if we go back and we look at February's options at the money is $22. That's here, not here. And that's kind of tricky and sneaky, right? Because you think you're getting some options that are in the money, out of the money. Well, I mean, if you don't know what you're doing trading the VIX, you're just going to give your money away. It's just all there is to it. I don't know. I like my money. I'm going to keep it. We are dancing around the put wall. We're underneath the 0 gamma line. We're underneath the volatility trigger. We're underneath the 3, the 10, and the 20 period moving average. We're really close to the 10 week, and we're really close to the 50-day. It's not a surprise. We've been talking about this all week, right? Level by level. All we had to do is break and go to the next level, and then break and go to the next level. Hopefully, you were able to monetize that, right? Because it's not like it was a surprise. We've got a 310 surge. That's a bear surge signal because we crossed underneath the 3 and the 10, and then we dragged the 3 through the 10, and we're still headed to the downside. Now, at some point, we're going to put in a base, and we're going to consolidate, and we'll begin to move back up again. But we got to start to see those signals first before we expect to get that sort of behavior. Now that we've reached the 50, this is not supposed to be my stopping point, right? I've been calling 50s, not the 50-period moving average, but 50s in price. 67.50 is broke. We're clearly underneath it. So that opens the door for 66.50. Now, we don't have to go there, but it would be a little rude to get underneath that 67.50, open the door, and send out the invite and then not have a party. That's rude. So unless or until we get back above 67.50, 66.50 is still on the table. That's the way it works. If we do get back above 67.50, then we've got our moving averages to deal with, and we can begin to digest all of that trash that's overhead. And there's a lot overhead. There's a lot of levels up there. There's pivots and points of control, old volume, lots of structure, right? So it won't be easy to get back up through there. Even looking at the dealer positioning and GEX levels, there's a lot of stuff up there too. Which is why I think we need to base down here, likely get through OPEX, and then if we're going to go up, then we start working our way back up. But we still need a reversal signal to go up, and we don't have a reversal signal yet. I've often shown in the past what some of these reversal signals look like. One of these long-tailed dojis, like a graveyard doji. I like it when we get to the bottom of a range, and then we get like a Monday gap down and a big old fall, and then a strong rally back up, like this bar right here. I think that's a really good example of a fall down and a rally back. But this one didn't have the gap with it, and it wasn't at the bottom of a range. So we're setting up really nice for Monday if we do get that sort of gap down, drop, rally, and then come back up again. That won't do us any good today because it's not Monday and we don't have the gap down. And so we just got to get there first. How today closes will be important, though, for a better picture on the week. So there's the 10-week moving average. You can see the white line, the 3-period. We've been holding that up since we got the cross back here. So through all the weakness that we've seen off and on throughout the summer into the fall, that white line's been holding clear, and we've stayed steady above the 10. Even when we've come back and tagged it, that's really all we did is just tagged it. We're looking to see if that's going to continue. If we get a clear close below that 10 week, then it opens up 65.50. That same level that we were talking about the other day. 65.50. And I know it's a long ways off. I get it. But it was a long ways off the last time I said we could get down here when we were way up here. Right? And that would get us pretty close to the 20-week moving average. Does he really have a stew recipe? Because I like stew. Of course, I don't eat horse and dog, so I might not want it. We are at today's ADR half. It does sound good, right? Hungarian stew? It does sound good. We made it to the full ADR yesterday, if you guys keep track of such things. And on the rebound, we went all the way back up to the ADR half. So we made the full run, and then we made the half on the bounce. Generally speaking, if we get to one side early enough in the day, we can get to the other side by the end of the day. And I say that, but how early is early, right? That kind of calls into question, how early do we have to hit this thing? I've seen it hit around 8:30 and still make it to the other side by the end of the day. But I don't like when we've hit it and we've started that move and then we come right back down again. That's not good. We're supposed to leave that range and get some work done. And the longer we don't do that, the more likely it is we won't do that. As for hitting the yellow line and coming back to the red, that's a pretty common occurrence. You can see the same thing back here. When we traveled the full distance and hit yellow on the rebound, we came back to the halfway point to the red. We have a market maker move this morning, and yeah, we got all these extra lines because we're looking at the previous days, which I normally have turned off. That's why. The market maker move tells us they are in here hedging today. Now, they're always hedged. It's not like they're running around naked. This is additional hedging. There is something happening in the economic space that has them worried enough that they're spending money on insurance. Now, this isn't like you and me deciding we're going to, quote, put on a hedge by buying some puts, something that we could monetize and limit our risk. To them, it's pure cost. The money that they spend today on these hedges is going to be just like lighting a fire and throwing money into it. And yet they're willing to do that today. They're willing to do that to protect the bigger picture. And they wouldn't just light money on fire if they didn't see that there was some kind of risk. Well, we just went through the economic calendar. I didn't see anything that would warrant them hedging. So it's not on the calendar, it's something else. It could be data that we're going to get out of Europe. It could be the meeting with the president and Hungary. Who knows, right? But they're upset about something and they are hedging this morning. That's not my opinion. I'm not, just pulling that out of thin air. We can see it. The market maker move tells us that they're hedging. So we want to keep our eye on this and see if the number begins to decrease and at what point. It should happen around 8:30. If it's 8:30 data or 9 or 9:30, whatever the data point is, or after some big headline. Now, this thing has a life of only today, right? So at some point, it will begin to decrease anyways because it's going to run out of life. But we would want to see that start to decrease earlier than noon. So just keep your eye on the clock, keep your eye on the headlines. And when this starts to fade, then you'll know that whatever event they were worried about, it's past us. And they're no longer worried, and they're beginning to unwind that hedge. That's pretty neat. Who'd you use to do that? The Gemini? Copilot? Really? If we begin working our way to the upside, 6811 is on the table. Ah, yeah, I got you. I've been using the Google AI for summaries and Grok for load orders, mod load orders. All right, we're continuing the breakdown, so it's very unlikely that we're going to make that move up. But if we drop down into 111 or 1236 and then we get that reversal, get through the midpoint of our Globex range, then through the top of the range, and then up into that 6811. Also remember there's a 6792 cog line. There's a 6732 cog line, which really that's yesterday's low, and it's this Globex pivot right here. And then we've got yesterday's 111. I love yesterday's 111. This is one of my most profitable trades. This is only the RTH right there, which is getting hit on the 1236 right now. If we was to expand through that, then I would go ahead and take the whole thing high to low. In fact, I'm just going to go ahead and move it to the full move. There's yesterday's 111 and the 1236. If we were going to turn around, it would very likely happen around this 1236 area. Now look, it doesn't mean that it has to drop down there like some V shape and just bounce and go. We could do like we did here, get down there and chop about for a while and then go, right? Sure, it's always nice when it does that, but it doesn't have to do that. We could get down there and we could just put in some basing for a while and then finally start getting after it. But that reversal has made me so much money. And it's probably the one trade that I trade more than anything else. It's why I'm picky about trading in the middle of a range, and I just don't care to do it. Right? I don't care to trade in the middle of this trash because I don't have to. So let's see how this flip goes. If we start working our way back up, we got the levels, and the ultimate target is 68.11. If we can get through that ADR half, then we'll aim for the full ADR, which is Wednesday's high. If we continue to sell off, you already know it's 66.50 and then 65.50. Not necessarily today, but we're running 50s all the way down. That's been my mantra, and it hasn't stopped yet. Okay, we are getting a little extended from this weekly pivot point. It's something to consider because how far away we get from that weekly pivot matters. We're not yet 3%, so I don't feel that we're at the extremes of a point where we would be looking for a reversal, but there's no perfect answer for how far away from the weekly pivot can we get on a 5-day period. In the past, when I was doing a lot of work on this, if we've stayed above the weekly pivot for a long time, we don't have to get very far away on the downside before we get mean reversion. 2.5%, 3% is just about all it takes. But if we've constantly been running underneath the weekly pivot and hitting 2.5%, 3.5%, 3.5%, 3.5%, then it's not enough anymore. And we need something like a 4.5% or a 5% move to really start to see any sort of mean reversion. So, we haven't been this deep under the weekly for a little while. It might be enough, but I would say more likely a 3% move. So from the pivot, here's 3%. That gets us underneath 6,700, right around that 66.92 area. It's not a game of perfect, but right around in there. I think if we get that far today, we could start to see some mean reversion simply because of the distance from the weekly pivot. But it's also Friday too. So, something a little more close in might be appropriate. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it, and that's also bearish. Now, we haven't hit that floor pivot today, and we generally would do that. Markets tend to hit their pivot more than they miss. So we have a little bit of a bias that says we should go up and hit this pivot, but we don't have to. It's a missed daily pivot right now, but we won't call it that until the day ends and we look back and say, oh, wow, look, we never did hit that. So it's a possible missed daily pivot at this point. We are at S1, and that puts R2 on the table. That R2 is right on top of the weekly pivot. And I like how that just lays out really nice. So if we begin the run back in the other direction, aim for the floor pivot, get through that. You got R1 and then R2, which is the weekly pivot. We could easily do that. All we need is a little bit of juice. It is worth noting today that the indicator isn't biased really in one direction or another. Usually one side or the other is elongated, giving you a hint that it sees it's more likely to go, up or down one way or the other. We don't have that today. They're almost equal. Now, I'm sure there's some Canadian engineer out there who's going to get this out with his calculator and show that there's a couple of ticks difference up or down. Whatever. I'm eyeballing it and it don't look that different. I'd rather deal with one that has a very obvious extreme differential where one side is much greater than the other. And we don't have that this morning. So the indicator isn't giving any indication of going to the upside or downside easier. If we continue through S1, then we've got S2 and S3. S3 really lines us up at 65.50. You like that, don't you? The numbers always just come together, right? That's just the way it works. This point of control from mid-October did nothing for us. I mean, just nothing. The same with this one in the first week of October. We cut through those. Well, okay, maybe we got first bounce on that one. Maybe. A really nice first touch bounce. But the second one seems like we ran right through it like it wasn't even there. Now we're underneath of both of those. And I would treat them like a zone, a level that has to be worked through. It is interesting how shallow this week's zones are in that area, right? Look at that. No real volume footprint in there. They took a front run on it and they piled in after it, but they really didn't put any work in through the middle of that zone. We've got 3 different distributions this week. Unfinished business from last week was up here to start everything off. Then we put in most of our work this week in the middle. Now we're kind of expanding out of it on the downside. I'm interested to see what kind of tail we're going to leave behind. Like we've talked about before, how we reverse, if we reverse, how we reverse is really important. Is it going to be a reversal like this that has that sort of volume connected to it? Or is it going to be a reversal like this that has that sort of volume connected to it? That's a big difference, huh? Now, to be fair, this one that I'm pointing at down here, it ended the week on Friday at those lows. We didn't have a chance to build it out, turn it around, and run it back up. We gapped up the next week somewhere in here, and then, we put in a week's worth of work up there. But hey, it's Friday, right? We could do the same thing all over again. Get one of these deep drops, leave no tail, or leave no volume shelf here, and leave only a tail. So, got to see how it runs out, right? At the moment, I would be concerned of that sort of behavior happening to get us down into that same level too, 65.50. We're supposed to have some speed bumps, right? At this point of control here, for an example, it's 67.11 cog line. We're coming into that area now, really. And that lines up with another one from back here. 2 levels. Don't argue with me. Just do it. That really does look like the last hurrah, the line in the sand. It's a sloppy distribution. 10-day, 30-minute volume profile and TPO. The TPO and the volume profile line up with their point of control relatively well. The candles that made those aren't going to get taken out for at least another 10 days, 7 to 10 days. So we've got a long time before we see those move. The only thing that's going to move it sooner is if we stop and just build out a spot and bring them down early. And maybe that could be this range here that we started to work on yesterday afternoon. We could come back up into that and build this out more. Otherwise, I would expect to get into a stronger zone and then build it out. That stronger zone could be higher up, or it could be lower down into that 65, 50 area. Either way, at this point, this is a really ugly distribution. The point of control that is overhead is not likely to move anytime soon, and we're not going to see price react to any of this. It's all too far away. The value area low, the point of control, they're in their own time zone at this point. We don't have a new VPOC from yesterday because we've cut through that level multiple times. Now, don't get me wrong, the textbooks will tell you to carry these lines forward into today's trading, but I've got enough pivots. I don't need them. You do you. If you want them, carry them forward. If we break through this Globex range to the upside, you probably want this line. It's 67.83. It wouldn't hurt to carry that one forward today. But that's straight out of the textbooks. There's no magic to that, right? We are seeing some work getting put in at these lows. The TPO is really shallow, but the volume profile is building out. That is telling us that it's not a lot of trades, but a lot of volume in those trades that are coming in at these lows. It's nice to have both of those put together that way, right? You kind of get an idea of what's going on. If it was one lot wonders, then the volume profile and the TPO would look very much the same. But when they're running, 20 lot and 40 lots, then you have less trades, but more volume in those trades. And that's what we're seeing on this reversal. One lot wonders. Yeah. It's easy to be diamond hands when you've got a one lotter. Oh, that's all silly stuff. So that's about the only insight we get out of that at the moment. And it is Friday, so we have a preview of next week's range, but it's only a preview and it's not set in stone yet. So this can still change. But I like to look at it on Fridays to give me a little bit of a tell for what the markets are pricing in for next week. Because, they can get on TV and chip their teeth, little bobbing heads, just running their mouth. But show me the money, right? That old phrase still sticks. Show me the money. Where are you putting your money? Because what they're trading and what they're saying are always two different things. These ranges are based on what they're trading, not what they're saying. What I look for is the distance in the range. Is next week's range equal to or greater than the week's range that I'm in right now? If it's narrower, why? Events like CPI, PPI, non-farm payrolls, anything that can cause the market to contract for a day and a half before the event happens will cause us to have a narrower range. Those are known unknowns. When we know that an economic event is coming, but we don't know what the data is going to be in that event, then it's a known unknown, and we'll get a narrower range. But if it's a really big range, they're pricing in volatility, not from an economic event, but from something they're scared of. They think that something's going to hit, make the market make big moves, and they're pricing those big moves in, and it will broaden the range out. Next week's range is a little bigger than the week's range that we have right now. Well, what do we got on the table for next week? Or what did we have on the agenda this week that made ours so narrow? Because if ours was a narrower range, maybe the bigger range of next week is just us getting back into normalcy. We had QRA this week, and we had FOMC the week before that, right? So if we look at last week, and we look at the week that we just had, and then we look at the week coming, the volatility is getting bigger. Since FOMC, the range has gotten a little bigger each time. We're moving away from calendar events and we're moving into, hey, I think the market's getting violent and we're going to price in some bigger moves. It's a little tricky because we don't have all of our data, right? We're supposed to see things like non-farm payrolls, which is normally volatility suppressing, and we don't have it. So, work with what we got. Next week is projecting a little more volatility than we had this week. It is worth noting that we are outside of the weekly expected move at this point, and should we rally, we'll be back inside the box. We have an 80% chance of getting back inside that box. It's only supposed to be 68 point blah, 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 because that's the one standard deviation. But I'm telling you, the S&P has an 80% success rate with its expected move model. That's not on a day-to-day basis. That's, on a year-to-year basis. Historically, look back at the S&P and its success with its expected move. And 80% is the number, not 68 point blah, blah, blah. It has a really accurate expected move model. So there's an 80% chance that we close inside this box at the end of the week. I will preface that by saying when we are in economic uncertainty, when we're in higher volatility conditions, we're more likely in the 20% zone. What I mean by that, if you have an 80% success rate system, then that means 20% of the time it doesn't work. Well, most of the time, the market is in this sort of a regime. So we run the 80%. When the market isn't in that regime and we are in a market that's doing unusual things, then we get unusual outcomes. So yeah, it's an 80-20, but I think we're in the 20 zone, not the 80 zone. Orale. Uranium is up, down 14.5% over a 5-day period. I would expect to see an up move soon off of that, right? It's at support now after having fallen 14.5% over a 5-day period. It's about time we see a little bit of bounce on that thing. Doesn't mean it's going to happen today, though. We could finish it out and start to get that bounce on Monday. The China group, KWeb, we're barely down at all over a 5-day period. So we gave it all back. And sure, we're down almost 2% this morning, but over a 5-day period, we're basically just down at 1%. Boy. More China. Quantum down 4% over 5 days, just 1% today. So we got a lot of things that are red, yes, but put them into context of what have we done over the last week, and then look at the redness. If we've been running hard to the downside and we're still red today, like uranium, we're likely going to see that pause, maybe even flip. But if it's something like nat gas and we're down 2% today, well, we were up 9% over a 5-day period. I mean, come on, that's nat gas. It's not some penny stock. A 9% move is a big move. 2% on a drawdown makes perfect sense after running that far. Tech, mags, UFO, which is basically just risk. Emerging markets is China again. Chips, Bitcoin, chips again, more Bitcoin. I don't see precious metals in there. Did I miss it? Went too fast? Nope, I did not. Gold miners are up, and junior gold miners are up. And the Mag 7 down volume is up. Over a 5-day period, it's up almost 9%. It's about time for the Mag 7's down volume to stop going up, get a little bit of a pullback. And the VIX is up 19% in a 5-day period. It's up 5% this morning. There's been a lot of talk about VIX and the last couple of days, depending on the platform that you use. If you have Thinkorswim or if you have TradingView, you can turn things upside down. So if the VIX going down when the S&P goes up, if that confuses you, and I get it, when you're new, you got to get used to stuff, flip the darn thing over. That way, it actually moves in the same direction that SPY moves, and your brain can understand it easier, right? So here, the VIX is inverted, so it's going down the same time that SPY goes down, and it goes up when SPY goes up. That's a lot easier for us to, work around our head when you get more comfortable with trading and, you get comfortable with inverse markets, then you won't have to do that so much. But it's a nice little trick, and it's just an easy fix, right? So just flip the VIX over. Now, if you're on TradingView, don't use the minus sign. On TradingView, you got to use a math signal, right? So it's going to be VIX times, which is that little asterisk, -1. Because if you multiply a number by -1, what do you get? The inverse of that number. Remember when you argued with your math teacher, you're never going to need that math? Well, maybe you needed it after all. All right. So just do that, and then you can flip the VIX over, and it'll make it easier to understand the inverse correlated relationship. So we need to get back down below 20. I know that there's more sophisticated levels than that, but 20 is just a really simple line in the sand. And the floor pivot for the VIX is basically 1920. And so, that's the next level. If we get through $20, then we'll aim for that. Just getting back inside of yesterday's range would be a good start on seeing some weakness in the VIX. Then get through the close of yesterday, and then, of course, the floor pivot, then the low of yesterday, on and on and on, level by level by level. If we don't get weakness in the VIX, then we're not going to get a rally in the markets. Or if we do, it would be a rally that doesn't come from the broader market. It would be a rally strictly brought in by, say, 0-day options or something like that, right? Because if that sort of activity was to come in, then it wouldn't matter. Nothing else would matter, because they can just come in with 0 days and hammer it. But why would they at this point? And we got the dollar headed back down. So the headwind of a rising dollar is gone. That's helpful to markets. We need this to stay flat and or continue to fade, but no big sudden moves. We don't want, bunch of violence in either direction. Weak dollar, continue to head to the downside, nice and easy, without any sort of wild shenanigans, and that'll help us today. If the dollar turns around and starts going back up, that's going to hurt. That is a headwind, and it'll make it harder for the S&P and the NASDAQ to have a rally. It's a fairly simple trading day today, guys. And I'd like to not get the rally today, right? I really want that gap down rope-a-dope move on Monday. Well, I want one of those. Good long tail end of, like 65.50 with a solid gap down, scare everybody. They puke their positions, trap the bears, run it, squeeze it till their heads pop. Sounds like a plan to me. Simple enough today, GTFO. We got to get out of the box to do anything else. And we got the put wall, zero gamma, volatility trigger, the 3, the 20, and the 10 period daily moving averages over our head, and the 3-week too. So all that trash, all that resistance, all that drama waiting for us. I really see if we go up there, there's going to have to be a really, really good headline. Otherwise, why would they? Yeah. That's what I got for you guys. Be careful, be safe. Have a good weekend.